Welcome back to the channel. A lot to unpack this week, a lot to talk about, especially around the federal government's new changes to insured mortgages. What are the changes? What can they impact? How are they going to impact first-time home buyers? What does this mean for the real estate market? And who stands to really benefit here? I think that is the big question. I want to share our thoughts and opinions on these particular changes that are going to come into effect on December 15th. Now, if you haven't subscribed to the channel, we invite you to go ahead and subscribe to the channel, hit that notification bell so you can stay up to date with all the news around real estate and mortgages, obviously what is happening in the market. And more importantly, if you learned something in the video, please consider giving the video a share and a like. It does help the YouTube algorithm. And don't forget to leave your thoughts, questions, and comments and concerns in the comment section below. I'm sure we're going to hear from a lot of our viewers about these particular changes. So let's get right into these particular changes. So what happened on Monday was that the federal government decided to increase the amortization on default insured mortgages. Those are mortgages with less than 20% down. So if you were buying a home previously or up until December 15th, you had some different criteria, right? You weren't able to buy a home over $1 million. You had to take a 25-year amortization. You had to pay default insurance premiums on that mortgage. So depending on the size of your down payment, obviously depending on your income, you would qualify for a specific amount as long as it was below $1 million and providing that it was a 25-year amortization. You can always take less, you just couldn't go more than 25. Now, all that's being turned over right now, effective in December. With these proposed changes, you'll now be able to take a 30-year amortization, a maximum amortization of 30 years, and you'll also be able to purchase a home above $1 million up to 1.5. Now, this is obviously monumental for first-time home buyers, as it does give them more access to buy a larger home or a home that fits their needs at a higher price point. Obviously, taking on that 30 amortization that can take away or relieve some of that monthly burden, that affordability. Increasing the amortization obviously decreases the payments, and it can definitely give many Canadians potentially more buying power. And obviously, these are really good steps. I mean, for the longest time being in this industry, we've seen a legislation that's made it more difficult, more restrictive policy. And for the first time, they're sort of loosening that policy. My question is the timing around the loosening of these policies. I mean, we definitely have a Liberal government right now that is failing in the polls. You know, the potential for a snap election. Are they basically looking at homeowners saying, hey, look what we're doing for you. We're allowing you access, more affordability to get into the market as a last-ditch effort to maybe gain some voters? Or is this really a legitimate, potential for home buyers? And always have to think about, what this means on both sides of the equation, because we deal with a lot of first-time home buyers that eligibility, qualification on buying a home that was, in their price point, they just weren't qualifying on a 25-year amortization, and, they found themselves being priced out of the market. So with this increase of, from 25 to 30 years, it allows them a little bit more flexibility to get into the market. It also allows them to buy over $1 million, as we've talked about in certain markets, Toronto, Vancouver, these hotter markets. Prices for single family homes, towns and semis can be well over $1 million, right? For a starter home that a family needs to grow their family, right? A little bit more space. So this is allowing Canadians the opportunity to sort of get into this space. But at the end of the day, really, I mean, yes, it does help first-time home buyers who are willing to stretch themselves, take on these larger mortgages. Who really benefits, right? Is it the realtors that benefit? Is it the mortgage brokers that benefit? Is it the government that's collecting, higher and more land transfer taxes on this? Is it going to be the banks making more money on those interest payments? Is it going to be the insurers like CMHC, Sagan, and Canada Guarantee collecting higher premiums on these particular higher priced mortgages? Obviously, as we get through this stage, we don't really know the sliding scale, because right now, if you were to buy a home, right, just to make this point very clear, the first $500,000 that you would take out as an insured mortgage where you're paying the premium, you need to put a minimum of 5%. That's the bare minimum. So that's on $500,000, that's $25,000. And then anything above the $500,000 threshold is 10%, right? So up to the $1 million mark. So now what is the proposed changes? Once we go over the $1 million mark, is it going to be 15% of the difference? What will that look like? And ultimately, we have to understand that as Canadians are feeling the pressures, I mean, yes, we are currently in a rate cutting cycle here in Canada, with the US obviously cutting. We definitely have inflation pulling back to 2%, things we've talked about on the channel before. I mean, this is going to make affordability maybe a little bit better on clients who have higher mortgages, those interest rates, those lines of credits, credit cards, so on and so forth. But when you're taking on a larger mortgage on a 30-year amortization, you have to understand the consequences of that, right? By extending the mortgage to 30 years, you're going to take longer to pay off the mortgage. More interest is going to the bank. But yes, many Canadians are going to look at that as a monthly savings, right? A cost affordability per month. So we have some clients that are very conscientious. They know we want 25, some say we want 30. Most Canadians who don't live in a spreadsheet, they're looking at it saying, how much is it going to cost me per month? Buying the payment and saying, I need to buy this house. This is what our family needs. If I can save a couple $100 a month by going to a 30-year amortization, then so be it. But ultimately, is that we have to ask these questions. So as we continue to roll out and get through into December, once we get more indication of what is happening with these changes, we'll definitely be providing all of our viewers with an update. So make sure you are subscribed. But I really want to just round out the video by talking about how these changes can really impact the real estate market. And obviously, being in the industry for many years, we've seen the correlation between interest rates, home prices, and as interest rates drop, home prices tend to go up and vice versa, right? But now what we have is an environment where interest rates are coming down. The Bank of Canada is cutting. The economy is obviously not in the best shape. But ultimately, what we have to understand is that Canada is a housing economy. Everything in Canada is pretty much surrounded by housing, whether it be construction, real estate, finance, furniture, whatever the case is. The knock effect on real estate is actually pretty big. And then we've talked about on the channel, I would argue it's around 20%, if not more, of GDP. So we take that into consideration. We have builders that aren't building, we have Canadians that aren't buying homes, banks that are losing money, governments that aren't collecting revenues from land transfer tax, these purchases, all these transactions. We have a government, a liberal government in decline, trying to really maybe win over some votes. We have to look at the forces at play. We have, banks that are potentially losing out on possible revenues. We've talked about in our rate war episode, where banks are being very competitive to try and win over their business to make sure that they're going to dominate that market share. So with all that being said, I mean, think about the real estate market as it stands right now. Well, we have two forces really playing in right now. Not only do we have interest rates dropping, as I mentioned, we have the Bank of Canada cutting, as we talked about, but now you have a actual change in policy that's going to potentially create more awareness, more activity amongst first-time homebuyers in a certain segment. Now, the segment obviously could be condos, could be single-family homes, but if we take a second to understand the old rules that we talked about at the beginning about insured mortgages, being that you had to take a 25-year amortization under $1 million purchase price, that pool of buyers in the existing market means that you have a lot of buyers that maybe are looking at a home under 1 million, right? If you're an individual looking at a home under $1 million, you are competing against people that maybe have 20% down. You also have people that are buying with less than 20% down. So you have a larger pool of buyers. As soon as you stepped over the $1 million mark, there's still a lot of buyers in that space, but you were required to have 20%. You needed over $200,000 as a down payment. And that was a pre-qualifier to get you in over that $1 million mark. But now, with these proposed changes to go to 1.5, you have to also consider the fact that now you've widened the buyer pool. Now you'll have more potential professionals, young Canadians who are making the payroll. They do make the money. I mean, obviously, depending on how much you make as a salary will determine how much you qualify for. But just to really think about it now, between 1 million and 1.5, that is going to be a larger buyer pool. Once the market does eventually wake up, I mean, it's not a matter of if, it's a matter of when, because we have a lot of buyers that are pent up waiting to go into the market. Many of them, looking at the opportunity right now with the Bank of Canada potentially being on their fourth cut in October on the 23rd, just coming around the corner. So we have to really take these things into consideration. What does it do to the dynamics? Is these particular changes, going to actually inflate prices on homes that were previously under $1 million? Is it going to create more demand for homes that are just over $1 million? Because let's put it into perspective. I mean, for a $500,000 mortgage under the current guidelines, let's say at a rate of 4.54%. Let's just use that rate. To qualify for that $500,000 mortgage, you need to make about $126,000 of combined income with no debt. To qualify for, let's say, an $850,000 mortgage, you need to be closer to $200,000 of income, family income, to qualify for that mortgage. And if you're looking at $1 million mortgage under these new rules that could be coming into effect, you need to have a combined income of around $230,000, right? And because you don't have to come up with the full 20% anymore, right? That is going to be a game changer for a lot of first-time homebuyers who have the income, young professionals that are looking to gain entryway into the housing market. But ultimately, you have to really consider, I want a house. How much am I going to pay for this house? What are the interest costs going to be? How much am I paying over the life of that mortgage? And although this is a great step to get buyers into the market, it's going to potentially make a change, right? We're going to see in the coming weeks and months ahead, leading into December, we're going to see an uptick in people trying to get into the market. Are sellers that have a home that is just below $1 million going to wait it out? Are they going to maybe say, hey, wait a second, come December, I might have more attention on my home. What is that going to do to my sale price, right? So these are the things we have to consider. But we always ask, who do you think stands to really benefit from these changes, from these proposed changes that are going to come in December? Let me know what you think in the comment section below. But until next week, thanks a lot for stopping by. We'll see you next week.